my thesis is that the last 2 years of central bank buying and Chinese consumer buying were simply a prelude, were simply an hors d'oeuvre, if you like, because the economic factors that generally are in place to start a gold bull market were not in place. So in my view, we've only just seen the beginning of that new gold bull market, when the Fed started cutting rates. And so in the beginning of a bull market, it's always the case that money goes first to the large miners and the large royalty companies. That's normal, and we shouldn't expect anything different this time. So, I think money will flow down.
China's central bank has demonstrated renewed interest in gold, expanding its reserves for the second consecutive month in December. According to Bloomberg data, the People's Bank of China increased its holdings to 73.29 million fine troy ounces, up from 72.96 million in November. This development aligns with broader trends in the global gold market. According to Adrian Day, president of Adrian Day Asset Management, the substantial gold purchases by central banks and Chinese consumers over the past 2 years may set the stage for a more significant bull market despite the absence of typical economic conditions that usually drive sustained gold rallies. The World Gold Council's latest report indicates a positive shift in gold ETF dynamics, with December marking the first positive month since 2019. Global physically backed gold ETFs attracted net inflows of $778 million, primarily driven by strong demand from Asia and Europe, while North American markets experienced modest outflows. Total collective holdings increased by 4 tons, reaching 3,219 tons. Gold's current price behavior is particularly noteworthy, which defies conventional market wisdom. Day points out that gold prices are strong despite robust job market data and tempered expectations for Federal Reserve rate cuts. This unusual pattern suggests a strong underlying demand for the precious metal, transcending traditional macroeconomic influences. A combination of hawkish Federal Reserve positioning and ongoing geopolitical tensions further shapes the market's current dynamics. These factors have dampened investor appetite for riskier assets, as evidenced by weakness in equity markets, while simultaneously supporting gold's safe haven appeal. The gold-dollar pair has maintained its upward trajectory over the past 3 weeks. However, analysts suggest waiting for clear selling signals before concluding that the current rally has peaked. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
One of the things that's most interesting to me, David, or most significant, is that, here you had jobs much stronger than expected, as we've discussed, much stronger. And the odds of a rate cut in January going down even further than it was going into this meeting, and the number of rate cuts and the speed of rate cuts in the next year going down, and yet gold is moving up. Mm-hmm. You would expect, other things being equal, you would expect gold to fall meaningfully on the narrative of deferred and slower rate cuts. And yet it moved up, and it moved up significantly. What that tells me is that there is a lot of buying power for gold. And I've kind of made this point that all of the groups that were buying gold over the last 2 years and the reasons they were buying gold, the reasons haven't gone away. You look at central banks, of course, which were the number one buyer of gold over the last 2 years. And when President Trump, or incoming President Trump, says that if people move away from the dollar, he's going to impose 100% tariffs on all of their goods. I don't know about you, David, but that doesn't make Brazil or South Africa say, oh, well, maybe we won't turn away from the dollar. If anything, it makes them want to speed up their purchases of gold, in my view. And we're seeing that. The last couple of months' numbers from the World Gold Council actually had a reversal. We had a bit of a decline in gold purchasing in July, August, September, but it's reversed, and China's back in the market. So the reasons that people wanted to buy gold, I just said central banks, but the reasons people have been buying gold have not gone away, and if anything, have been reinforced. Geopolitical events don't really have a huge, lasting, long-term impact on the gold price. We've seen this over and over again. And if you look at when Russia first invaded Ukraine, gold was up strongly in the 6 weeks while they were massing their troops and tanks on the border. moved up a little bit more after they actually invaded. And within 6 weeks after the invasion, gold was right back to where it was before they started massing their troops. And that's a typical pattern for geopolitical issues. They tend not to have lasting impact on the price of gold.
So you don't think gold is currently pricing in a geopolitical risk premium that may disappear?
Look, there is a geopolitical risk premium. It's a positive, not a negative. I mean, a positive for gold, not a negative for gold.
Yes.
I just don't think it's a big factor. And again, to get to my fundamental point, the major buyers of gold, are central banks going to stop buying gold because there's a peace treaty in Ukraine? I don't think so. And we certainly haven't seen, the rumors of it. We haven't seen I think it's true to say a little bit of easing of tension in the Middle East. That hasn't had any negative effect on the price of gold.
Goldman Sachs has issued a cautionary outlook for U.S. markets in 2025, suggesting investors should prepare for a significant market correction. The investment bank's analysis points to multiple risk factors that could pressure equity valuations, including rising bond yields and potential disappointments in economic data and corporate earnings. The timing of this forecast is significant due to global financial shifts, particularly in BRICS nations promoting de-dollarization. This adds complexity to the market outlook and could influence global capital flows. Goldman Sachs notes that potential earnings growth may drive market progress this year, but it also highlights increasing vulnerabilities in equity markets that could trigger a correction. Adrian Day, a respected voice in investment management, offers complementary insights regarding potential investment trends. He suggests that 2025 could see a significant shift in capital flows toward defensive assets, with gold potentially benefiting from this reallocation. Day's perspective emphasizes how ongoing market uncertainties might drive investors toward stability-focused investments rather than growth-oriented assets. Let's get back to the interview.
There's two additional factors. One factor, of course, is we must never forget this, the enormous excess liquidity that was pumped into the world's economies over the last 12 years. And that money has to go somewhere. So that money goes to gold, it goes to stocks, it goes to bonds, it goes to Bitcoin. Everything gets a bit of that liquidity. But I think the other factor is, we just mentioned central banks. So the people that have been driving gold for the last 2+ years, 2.5 years, number one, central banks, number two, Chinese consumers. That's more in the last 12, 15 months. But the people that have been driving gold have been buying gold not because the U.S. stock market is or isn't going up, not even because the dollar is or isn't going up, not because of the inflation rate in the U.S. or the unemployment rate in the U.S. They're not, those economic factors and market factors are not what's been driving the gold price. But I think what you're looking at is, those factors have been affecting U.S. buyers. And that's why U.S. buyers have been very, very, really quite weak in the gold price. But an awful lot depends, I think, on how President Trump's first 6 months really play out. And that's not clear to me at all. But I think, let's say, absent things going a lot smoother, I can't help thinking that money is going to start rotating into more defensive assets, into value-oriented stocks, into income-oriented stocks, but just generally more defensive. My thesis is that the last 2 years of central bank buying and Chinese consumer buying were simply a prelude, was simply an hors d'oeuvre, if you like, because the economic factors that generally are in place to start a gold bull market were not in place. So in my view, we've only just seen the beginning of that new gold bull market, when the Fed started cutting rates. And so in the beginning of a bull market, it's always the case that money goes first to the large miners. And the large royalty companies. That's normal, and we shouldn't expect anything different this time. So, I think money will flow down. Let's not forget the gold stocks, the XAU. If you look at the XAU, it's up 25% in the last 12 months.
Yeah.
No, that's not chicken feed. It's certainly not the kind of leverage we expect on gold, but it's not chicken feed.
Gold's strategic movements reflect its enduring value as a hedge and the evolving sentiment tied to broader economic shifts. While challenges remain, the potential for new opportunities amidst anticipated market adjustments highlights the need for adaptability in investment strategies. How do you foresee the evolving global economic climate impacting gold's role as a key financial instrument in the near term? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.